Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. Pacific on Saturday, August 26th, 2023. Welcome back to the Crypto Overnighter, where we have no sponsors, no hidden agendas, and no BS. But we do have the news, so let's talk about that. I do seem to be coming down with a bit of a cold or something, but I think we can keep it together enough to put out this show. And it's a good one, because tonight we dig into the IRS's sweeping new tax rules targeting DeFi and NFTs. We'll also explore the significant implications of BRICS ditching the US dollar and what it means for cryptocurrencies. Federal Reserve Chair Jerome Powell sends shockwaves through the Bitcoin market, and we'll tell you why. Worldcoin faces regulatory hurdles, and we examine why PayPal's stablecoin PYUSD is struggling. Finally, we discuss the recent moves by Hashkey and the Hong Kong Monetary Authority to reshape the financial landscape. Strap in, it's going to be quite the ride. The IRS and the US Treasury have proposed new tax rules affecting the crypto industry. The proposal is part of the 2021 Infrastructure Investment and Jobs Act. It aims to define brokers in the crypto space, affecting centralized exchanges, payment processors, some hosted wallet providers, and some decentralized exchanges. A new tax form, 1099-DA, has been introduced for these brokers. Miners are exempt from these rules. The proposal is open for public comments until October 30th, with public hearings scheduled for November 7th and 8th. The IRS's new draft rules are a double-edged sword. On the one hand, they bring clarity to an industry plagued by regulatory uncertainty. On the other, they're an overreach that could stifle innovation in the DeFi sector. The proposal's broad definition of broker could rope in entities that don't have the means to comply with such regulations. It's a clear sign of the government's lack of understanding of how decentralized systems work. Congressman Patrick McHenry criticized the proposal for not being, quote, narrow, tailored, and clear. The Blockchain Association and the DeFi Education Fund have also expressed concerns. The Blockchain Association warns that rules must be tailored to the unique nature of crypto assets, while the DeFi Education Fund called the proposal confusing, self-refuting, and misguided. The government's move to regulate crypto is not just about tax revenue, it's about control. The decentralized nature of crypto is a direct challenge to the centralized power structures that the government and traditional financial institutions represent. While the IRS assures that new rules could help everyday crypto users comply with tax laws, the broader implications are worth considering. The crypto community must actively engage in the public comment period to ensure that the final rules are fair and conducive to innovation. All right, we've dissected the IRS's sweeping new tax rules. If you're enjoying this kind of deep dive, hit that follow button and turn on notifications so you don't miss a beat. Speaking of government oversight, let's pivot to international waters. BRICS nations are making some audacious moves that could redraw global financial maps. Buckle up, you don't want to miss this. BRICS has officially decided to abandon the US dollar for international trade. This decision was unanimous. South Africa's President Cyril Ramaphosa confirmed it. BRICS aims to use local currencies for cross-border settlements. This move could reshape the global economy and political landscape. Brazil's President Lula da Silva mentioned reducing vulnerability by holding fewer dollars as reserves. 6 new countries are joining BRICS. They are Saudi Arabia, the UAE, Argentina, Egypt, Ethiopia, and Iran. Pay attention because 5 of these 6 are oil-producing nations. South Africa's president also hinted at a second phase of BRICS expansion. No detail on which countries might be included in this second phase were provided. BRICS now controls 30% of the global economy. Saudi Arabia leads these new members with a GDP of $1.06 trillion. Argentina and the UAE follow with $641 billion and $499 billion respectively. Egypt and Iran have GDPs above $360 billion, and Ethiopia has $156 billion. The BRICS alliance is making moves that could send shockwaves through the global economy. Abandoning the US dollar isn't just a statement, it's a declaration of economic independence. This could be a significant blow to the dollar's global status. The alliance isn't just stopping there. They're actively recruiting new members, expanding their influence, and now control a significant chunk of the global economy. What's more intriguing is the inclusion of oil-producing nations like Saudi Arabia and the UAE. This is clearly a strategic move to challenge the dollar's dominance in oil trade. Imagine oil transactions happening without the US dollar. That's a scenario that could accelerate the dollar's decline. This expansion to control 30% of the global economy is a clear signal. BRICS isn't just an alliance. It's becoming a formidable global entity. With plans for further expansion, we could see these percentages rise even more. This isn't just about economics, it's about power dynamics. BRICS is positioning itself as a counterweight to Western influence, and they're doing it effectively. So what does this mean for the crypto community? Well, as BRICS moves away from the dollar, it could open up new avenues for cryptocurrencies. A decline in dollar dominance could make decentralized currencies more appealing. It's a development worth watching, as it could have far-reaching implications for the world of crypto. That was tonight's whirlwind tour of BRICS' geopolitical gambit. Want to stay ahead of such seismic shifts? Like this episode and subscribe for more. Now, let's tune into a different frequency. Jerome Powell and the Federal Reserve. They're playing a tune that Bitcoin doesn't quite like. Let's dive in. Jerome Powell, the U.S. Federal Reserve Chair, recently spoke at the annual Jackson Hole Symposium. His speech had a significant impact on Bitcoin's price. Powell highlighted the rising inflation that he attributed to the COVID-19 pandemic. He emphasized the need to bring down inflation to a 2% rate. Powell also warned about potential interest rate hikes. At the time of his speech, Bitcoin was trading around $26,000. However, it experienced increased fluctuations as the event approached. Powell's hawkish tone led to a dip in Bitcoin's price. It slipped below $26,000, reaching as low as $25,800. The broader crypto market also saw modest losses. Solana, Arbitrum, and Optimism experienced steeper falls. The U.S. 2-year Treasury yield surged to an almost 17-year high at 5.1%. The dollar index increased to its highest level since March, creating headwinds for risk assets like Bitcoin. Powell's remarks have sent ripples through the crypto community. The Fed chair's hawkish stance on inflation and interest rates clearly unsettled the market. This isn't just a blip, it's indicative of the broader economic landscape and the Fed's tightening grip. The Fed has raised the policy rate 300 basis points since last year's Jackson Hole Symposium. The current federal funds rate is between 5.25 and 5.5%. The market's reaction shows that Bitcoin is still very much a risk-on asset. It's sensitive to macroeconomic pressures, especially those stemming from the Fed. Powell's speech has also led to a strengthening U.S. dollar, which further diminishes the appeal of Bitcoin as a risk-adjusted asset. This could also be a sign of things to come, as the Fed seems committed to a restrictive monetary policy to combat inflation. So what's the takeaway here? The Fed's actions have had a direct impact on Bitcoin and the broader crypto market. And given the current economic climate, this influence is unlikely to wane anytime soon. Keep an eye on the Fed's moves. They're reshaping the crypto world, whether we like it or not. Powell's speech has left the crypto world buzzing. If you're as intrigued as we are, don't forget to hit that like button. From central banks to ambitious crypto projects, Worldcoin is unraveling faster than a ball of yarn. Let's find out why. Worldcoin's value plummeted by over 50% within a month of its launch. Regulatory concerns have been a significant factor in this decline. The token's price dropped from $2.71 to $1.27. Regulatory bodies in France, the UK, and Kenya have raised data privacy concerns. The Kenyan government even suspended Worldcoin's operations. In fact, Kenyan authorities raided a Worldcoin warehouse in Nairobi due to data privacy concerns. Social activity around the token has dwindled, with a 95% and 74% drop in social volume and social dominance respectively. Daily addresses involved in Worldcoin transactions have also declined by 98%. An alleged whistleblower, Nadir Hajarabi, severed ties with Worldcoin. He cited horrendous execution and raised red flags about the project. Worldcoin aims to scan the irises of the global population for a so-called World ID. Over 2.2 million people have already given their biometric data to Worldcoin. Worldcoin's ambitious project has hit a wall of regulatory scrutiny and public distrust. The project, led by Sam Altman, aimed to provide a universal basic income through its cryptocurrency. However, the method of collecting biometric data for a World ID raised eyebrows. The regulatory pushback is a clear sign of governments not buying into Worldcoin's vision without concrete safeguards for data privacy. The whistleblower's exit adds another layer of complexity. It's not just the regulators. Even those inside the project have sounded alarms. This internal dissent could be the final nail in the coffin for Worldcoin, especially when the whistleblower is aiding authorities in their investigations. The decline in social activity and daily addresses indicates a waning public interest. This is a significant red flag for any cryptocurrency, as community engagement is often a barometer for a project's health. The dwindling numbers suggest that WorldCoin might be on a downward spiral from which recovery could be challenging. Now, from a faltering coin to a faltering stablecoin, PayPal's PYUSD is treading water, and not in a good way. Here's why. PayPal's stablecoin, PYUSD, is struggling to gain traction. Despite being listed on Coinbase, the stablecoin has not seen significant adoption. Nansen reports that 90% of PYUSD is held by its issuer, Paxos Trust. Only 233 people even hold PYUSD, and decentralized exchanges hold less than 50,000 tokens. The stablecoin was launched without prior notice and is built on the Ethereum network. It's fully backed by US dollar deposits and short-term US treasuries. Coinbase has also enabled PayPal linking for users in the UK and Germany. So what's going on here with PayPal's PYUSD? It's clear that the stablecoin is not living up to the hype. Despite the backing of a payments giant like PayPal and a listing on Coinbase, PYUSD is lagging. And let's not ignore the elephant in the room: centralization. The fact that 90% of PYUSD is held by Paxos Trust raises red flags. It's the antithesis of what the crypto community stands for: decentralization. But why is PYUSD struggling? One reason could be its launch on the Ethereum network. With high transaction fees on Ethereum, users might be hesitant to adopt PYUSD. Another reason could be competition. With established players like Circle and Tether, PYUSD has a tough road ahead. The Coinbase listing should have been a game changer, but it wasn't. Even the integration of PayPal accounts for German and UK Coinbase users hasn't moved the needle much. It's a clear sign that the crypto community is not easily swayed by big names or flashy partnerships. They want substance. They want decentralization. And right now, PYUSD is not delivering on either of those fronts. So where does PYUSD go from here? Well, it's hard to say, but one thing is clear. If PYUSD wants to gain the trust of the crypto community, it's got a lot of work to do. And it needs to start by addressing the issues of centralization and utility. Otherwise, it risks becoming another footnote in the ever-evolving tale of crypto. Now, if you're finding this valuable, don't forget to subscribe and get notifications for our daily episodes. Lastly, let's jet over to Hong Kong, where Hashkey and the HKMA are making moves that could be a game changer. Let's dig in. Hashkey is a crypto exchange based in Asia. Well, they're launching retail trading services in Hong Kong on August 28th. They will initially offer Bitcoin and Ethereum trading. This move comes after Hashkey became the first crypto company in Hong Kong to obtain a new type of license allowing retail services. The Hong Kong Monetary Authority also released a report on bond tokenization, stating that distributed ledger technology could improve efficiency, liquidity, and transparency in bond markets. The HKMA's report is part of a study called Project Evergreen. It highlights the benefits of going paperless and the ability for various parties to interact on a common DLT platform. Hashkey is also in talks with local brokerages to establish entries connected to its crypto trading services. Both Hashkey and the HKMA are taking a cautious approach to these new services. Hashkey has implemented stringent Know Your Customer protocols and does not allow users from mainland China to register. Both Hashkey and the HKMA are making strategic moves that could significantly impact Hong Kong's financial landscape. Hashkey's entry into the retail market is a clear signal of the growing acceptance of cryptocurrencies. Their cautious approach, including stringent KYC protocols, shows a commitment to compliance and security. On the other hand, the HKMA's exploration into bond tokenization could revolutionize traditional financial markets. It's a nod to the potential of blockchain technology to improve existing systems. However, these developments also raise questions about the broader implications for the crypto industry and financial markets. Hashkey's exclusion of mainland Chinese users aligns with the ongoing crypto crackdown in China, reinforcing the divide between Hong Kong's more liberal stance and mainland China's restrictions. The HKMA's report also subtly hints at the need for legal and regulatory adjustments to accommodate new technologies. Both entities are navigating uncharted waters, and their actions could set precedents for other markets. It's a delicate balance between innovation and regulation, one that could define the future of crypto and financial markets in Hong Kong and beyond. So, what happened? The IRS released a new tax proposal aimed at a broad swath of the crypto industry, which could both clarify regulations and potentially stifle innovation in the decentralized finance sector. Meanwhile, BRICS is distancing itself from the US dollar and expanding its alliance, a move that could significantly impact the global economy and the role of cryptocurrencies. Jerome Powell's recent speech sent ripples through the Bitcoin market, underscoring the Fed's influence on crypto assets. Worldcoin is grappling with a myriad of issues, from regulatory crackdowns to internal whistleblowing, marking a cautionary tale for the crypto community. PayPal's stablecoin, PYUSD, is failing to gain traction despite a Coinbase listing, raising questions about centralization and utility. Finally, Hashkey and the Hong Kong Monetary Authority are making strategic moves in Hong Kong's financial market, potentially setting precedents for crypto and traditional financial systems alike. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating, or maybe a review. And in the meantime, we'll see you tomorrow night.